The analysis report submitted today makes a really bold, bullish case for Oracle.
It argues that a recent stock drop is basically a 40% discount, all fueled by this massive, a $523 billion backlog from AI clients?
Let's jump right in and see how we can make that argument even stronger.
Okay, so the whole theme here is that the stock is on sale, and that headline, that 40% discount, it's a great hook. It really is.
It's powerful, but we have to make sure it's defined in a way that the target reader, a pretty sophisticated value investor, is going to buy.
Right, and I think that's the first big opportunity here. The analysis, it relies very heavily on historical price movement to define that 40% discount, rather than rigorously grounding the current $197 valuation with that amazing backlog data.
Exactly. You can see it right in the calculation. The 40% discount is just from the old high of $345 down to today's $197.
And the weakness there is that it's a behavioral frame. It's a great story, fear and greed, a big reversal.
But it isn't a fundamental valuation discount.
Not in the traditional sense. We have to prove the price is low because of the fundamentals, not just because it used to be higher.
The report even notes the PE is 37x. I mean, if you're going to call a 37 multiple a steal,
you have to earn it. You've got to show, fundamentally, why that number is actually undervalued, totally independent of where the stock was last year.
So the suggestion here is pretty clear, I think. We need to integrate a much clearer forward-looking valuation.
And one that's derived directly from that, just incredible number, that 523 billion RPO.
Yes, that moves the argument beyond just comparing prices and starts to quantify the certainty that the report is all about.
We need to show how that certainty translates, mathematically, into a higher intrinsic value right now.
Right. So for a concrete example, what about projecting out that $68 billion in quarterly RPO growth?
And for anyone listening, RPO is remaining performance obligations. It's basically guaranteed future revenue.
Exactly. So you could use that growth to calculate something like a PEG ratio, a price-to-earnings growth ratio.
And then the report can set its own fair value target. Maybe it's a conservative $280, for instance.
But now, the current $197 price isn't just a discount from an old peak.
It's a discount to intrinsic value, which is a much, much stronger argument. It's grounded in hard math.
That's a great way to refine it. Or alternatively, you could just give more context for that 37 by PE multiple.
How so?
Well, compare it directly to the other, high-growth, mission-critical players that the report mentions. The big AI clients themselves, or other cloud providers.
Oh, that's good. Because if you can show that Oracle's peers, the ones also building out this critical AI infrastructure, are trading at, say, 50x or 60x,
then suddenly 37x for a company with this kind of guaranteed backlog looks incredibly compelling.
Without that context, 37x can still feel a little rich. This really sharpens the on-sale thesis.
Okay, so once we establish that new valuation, it really hinges on one thing.
Their ability to deliver.
Exactly. Can Oracle actually fulfill that $523 billion promise? That's where Wall Street got spooked.
And that leads right into the next point. While the massive $523 billion RPO is the core evidence of demand, the analysis, it kind of dismisses the operational concerns without fully addressing the execution risks that come with fulfilling such huge obligations.
I see what it's trying to do. The analysis correctly says Wall Street panicked over the jump in CapEx spending.
And it reframes it really nicely as a supply problem, not a demand problem, which is a great line.
But it feels a little too easy, maybe? It just glosses over how hard that supply problem is to solve.
It is. Scaling up infrastructure to satisfy $500 billion in revenue for clients like OpenAI and NVIDIA, that's not simple.
You have huge execution risks. CapEx overruns, delays building data centers, supply chain nightmares getting all the GPUs you need.
And by not really acknowledging those very real risks, the report loses a bit of its robustness. It's asking the reader to just trust that management has it all under control.
Without showing how.
Right. So the suggestion for improvement is to actually introduce those risks and then proactively mitigate them.
Turn that potential weakness into a show of strength.
Exactly. You demonstrate that the company has the financial and operational muscle to handle the challenge. It makes the whole thing much more credible.
So what's a concrete way to do that in the report?
Well, one way is to dedicate a small section to Oracle's operational strategy. Or even better, talk about the structure of the contracts themselves.
What do you mean?
For instance, if the analysis can show that those RPO contracts have, say, inflation clauses built in, or payment milestones that are tied to CapEx completion.
So that protects the profit margins from rising costs. It directly answers the street's fear about spending.
It shows the risk is already managed in the deal structure. Another angle, and this would be very effective, is to juxtapose the hard question directly.
Like, what happens if the GPU supply chain gets even tighter?
Exactly that. And then you immediately answer it with evidence. Show Oracle's track record of delivery, or maybe a competitive advantage they have in securing those components over, say, Amazon or Microsoft.
That completely flips the narrative. It's no longer they are spending too much.
It's they have already secured the inputs and structured the deals to meet this massive, certain demand. The CapEx fear becomes a managed investment.
Which leads to the final point, I think, about structure and, who this is all for.
Yeah, the audience alignment. We've built this strong multi-year value case based on the RPO. But the report also has a lot of language for high-energy swing traders.
And I wonder if that creates some friction. The attempt to simultaneously cater to high-energy swing traders and long-term fundamental value investors creates friction in the report's flow and dilutes the clarity of the primary investment thesis.
I agree completely. You have all these very technical short-term indicators, things like V-shape recovery, a specific $185 stop-loss zone, a $240 gap fill target.
And that's mixed in with this monumental multi-year story about AI infrastructure and the RPO, which is supposed to get us to a $400 bull case.
It's a stylistic mismatch. It forces the reader to sort of switch gears between two very different strategies. You've got this long-term certainty thesis, but the language keeps pulling you back to, what's happening on the chart today.
It can be jarring. So the suggestion here is pretty crucial. The analysis has to pick a dominant thesis.
And let the other one take a back seat.
Right. And since the strongest evidence by far is that multi-year $523 billion number, the report should really focus on the value thesis.
And then just present the technical analysis as, an optimal entry point?
An optimal low-risk entry strategy for that long-term thesis, yes.
Which means changing some of the wording. So in that chart and target section, you'd get rid of aggressive trading terms like stop loss.
You don't want to alienate the technical reader, but you need to reframe it.
So instead, you could say something like, the established $185 floor acts as a structural validation point, confirming the long-term $400-plus valuation thesis.
That's perfect. It keeps all the technical info but aligns it completely with the long-term value story. It's not about trading, it's about entering.
And the conclusion has to reflect that focus too. If you're building this big value case, the final takeaway should be about that long-term conviction.
Reinforce the certainty of future revenue, not, watch the 197 level for a launch tomorrow.
Exactly. It makes the whole $500 billion argument feel more patient, more authoritative, and ultimately more credible. The RPO certainty is the star of the show. You don't want tactical noise to overshadow it.
This has been a really insightful breakdown. I have to say, the source material is already incredibly strong because of that deep dive into the RPO number.
It really is.